Welcome to new episode of Inside the Economist's Mind.
Great to be here.
Today we're doing a deep dive into a stack of sources you shared with us. They shed light on some pretty significant recent economic shifts and also some really intriguing social data.
That's right. And our goal, really, is to pull out the most important insights from this specific material. Think of it as, a shortcut to getting up to speed on these developments.
Exactly. So we'll be looking at two main things based on these sources.
Yep. First, the Reserve Bank of Australia, the RBA, their recent decisions, their thinking on interest rates, inflation, that whole picture.
And second,
We'll shift gears and look at some striking new data that's come out on the gender pay gap. First time for some of this public sector stuff.
okay, so consider this your guided tour through the need-to-know info in those sources. Let's get straight into it.
Sounds good.
Right, first up, the RBA's latest move. The big headline from the material is that the Reserve Bank cut interest rates again. That's the second time this year.
And that cut, it has a real impact, doesn't it? The sources highlight it could save mortgage holders somewhere between $90 and $150 a month.
Which is significant.
Yeah.
But it's interesting, the reaction noted in the material wasn't, well, universally positive. There seems to be quite a bit of skepticism mentioned.
Yeah, about the timing and also how they communicated it.
What specifically?
Well, the RBA governor's own statement is quite revealing. She mentioned, and this is pretty direct, a substantial increase in global economic and policy uncertainty.
Uncertainty like.
She specifically pointed to Donald Trump's trade war, basically saying it makes predicting future cuts extremely difficult right now.
Okay, so global factors.
Yeah.
But the criticism noted in the sources seems to focus more domestically, right?
Yeah.
On the decision not to cut rates 6 weeks earlier, back in April.
Exactly. Why wait until now? That's the question being asked in the analysis we looked at.
And does the material offer any clues from the RBA itself?
Well, their own quarterly statement on monetary policy just came out, and the data in that actually suggests the economy is weaker than they thought just 3 months ago.
Weaker how?
Households aren't spending as much as they expected. Economic activity, wage growth, inflation, it's all slowing down faster than their previous predictions.
So their own numbers were flashing warning signs even before this latest cut.
Seems that way. And the perspective offered in the material is that maybe the RBA was a bit hesitant to admit the April decision might have been, a misstep.
So they acted now because the slowdown is undeniable, but maybe didn't fully own that the earlier data perhaps already justified a cut.
That's the interpretation presented, yes. They acted with confirmation, perhaps, rather than preemptively based on the slightly earlier signals.
Okay, this leads to a really interesting, maybe even provocative claim raised in the sources.
You mean the idea that the fight against inflation is over?
That's the one. It sounds like a pretty bold statement. What's the reasoning behind it?
It boils down to a change in the RBA's standard language. The statement they issue after their board meetings. It's subtle, but significant.
Okay, tell me about the change. What was the old language?
For a long time, pretty much since mid-2022, they ended with something like, the board was resolute in its determination to return inflation to target and will do what is necessary to achieve that outcome. Keywords: resolute, return to target.
Got it. Resolute, return, and the new language.
Now it says, the board is focused on its mandate to deliver price stability and full employment and will do what it considers necessary to achieve that outcome.
Okay, so breaking that down, resolute is gone.
Yep. Maybe signals less, single-minded intensity just on inflation.
And instead of returning inflation to target, it's about delivering price stability.
Right. Probably because inflation is now back within their 2 to 3% target range. It's sitting at 2.4% according to the latest figures mentioned. So returning doesn't quite make sense anymore.
And the really big change seems to be explicitly adding full employment into that core statement.
Exactly. That mention of full employment alongside price stability, it really shifts the emphasis. And it immediately makes you ask, well, what is full employment?
Yeah, because the sources point out that's actually a really debated concept. It's not straightforward.
Not at all. There are different views. One perspective, sort of linked to the Department of Employment and similar groups, sees it basically as job availability. Meaning, effectively, anyone who wants a job can get one reasonably quickly, say in a month or two. Maybe not their dream job, but a job. It's about getting people into work.
Okay, that sounds intuitive. But the Reserve Bank's definition, as presented in the material, is quite different, isn't it?
Very different. For the RBA, as the analysis suggests, full employment is tied directly to inflation. It's the level of unemployment low enough but not so low that it causes inflation to rise.
And this is where that term NIRU comes up.
Exactly, the non-accelerating inflation rate of unemployment. It sounds technical, but it's core to the RBA's thinking described in the sources.
So what's the theory behind it?
Their belief, as outlined, is that if unemployment gets too low, below this estimated NARU level, businesses have to compete really hard for scarce workers.
By raising wages.
By raising wages, yes. And the fear is that kicks off a wage price spiral. Wages go up, so businesses raise prices, workers then demand higher wages to keep up, and it cycles upwards.
So if you boil that down, the RBA's view, according to this analysis, is basically that you need a certain amount of unemployment to keep inflation in check for everyone else.
That seems to be the implication. The sources mention their estimate might be around, say, 4.5% unemployment being necessary. It's a challenging perspective.
Especially when you look at the recent data presented in the sources, it seems to challenge that view, right?
It does. Unemployment has been low, around 4% to 4.1% for, 15 or 16 months now? A good long stretch.
And has the wage price spiral happened?
No, that's the point made. Wages haven't exploded. In fact, inflation has actually come down during this period of low unemployment. It hasn't accelerated. But despite that evidence, the RBA governor is still expressing concern about a tight labor market.
Yes, those comments are noted. And the analysis interprets that as the RBA still feeling unemployment might be too low, suggesting they'd perhaps prefer it to be a bit higher to create more slack and reduce any potential inflationary pressure, even though it hasn't materialized in the data so far.
It's a bit of a disconnect there. And they still see the current interest rate as restrictive.
Even after the cut to 3.85%, yes. They state it's still working to slow the economy, which is interesting given they also acknowledge the economy is already slowing more than they expected.
So where does that leave us looking ahead? What are market expectations for more rate cuts, according to the sources?
Well, the markets are definitely betting on more cuts. The material suggests anticipation for another one, maybe as soon as July.
July, okay. And beyond that?
Possibly 2 or 3 more by the end of the year. That could potentially bring the cash rate down to around 3.1%, maybe even lower.
And why do the markets think that? What's driving those expectations? They're looking straight at the RBA's own data. The figures showing the weaker economy, the slower wage growth. That tells investors that, logically, more cuts are probably needed to cushion the slowdown.
Okay, but what about that uncertainty the governor mentioned? The Donald Trump factor, global risks.
Right, the RBA acknowledges that uncertainty, but the material points out something crucial about how that uncertainty is described. It's seen as being all on the downside.
All on the downside, meaning?
Meaning the main risks aren't that inflation will suddenly roar back if they cut rates. The bigger risks are tilted toward the economy slowing down even faster than expected if rates aren't cut. Things like global trade disputes could make things worse, not better, for growth.
So given the RBA's own data showing things are slow, and the risks leaning towards further slowing.
Exactly. The opinion expressed in the material is that maybe the RBA should have gone further this time, a bigger cut, perhaps 50 basis points or any 35, to get the rate down towards, say, 2.75%.
Right. Okay. Let's pivot now, away from the RBA and interest rates to the second major topic covered in the material you shared.
Yes, the gender pay gap data. This is quite significant, the first release of this kind of data for Commonwealth public sector employers. It comes from the Workplace Gender Equality Agency, or WGEA.
A big transparency move. And the headline comparison is pretty stark, isn't it? Private sector versus public sector.
It really is. The sources highlight the average gender pay gap across the private sector sits at 21.1%.
Meaning, on average, women earn about 21% less than men across all those private companies.
Correct. But then you look at the public sector average, and it's much lower noted as 6.4%.
Okay, that's a big difference. Why is the public sector doing better, according to the sources?
Several reasons are cited. Women in the public sector are more likely to be in full-time, permanent roles. There tends to be more workplace flexibility available, like working from home options.
Which helps with managing caring responsibilities, often.
Exactly. Responsibilities that still often fall more heavily on women. And crucially, there are specific government policies actively trying to reduce the gap.
But even within the public sector, there are still gaps, right? The data wasn't all zero.
Oh, definitely not. The sources mention examples like the Australian Federal Police and the ABC, both around 9.8%. And in private media, it varied hugely. Mamma Mia apparently did well. Guardian Australia had a negative gap, women earning more on average.
Interesting.
And then at the other end, Radio 2GB showed a massive 51% gap.
Wow, 51%. That's huge. And the general finding across all the data was quite telling, too.
Yes, that men have higher average salaries in something like 96% of the occupations listed. That includes economists, surgeons, even roles like midwives.
The midwives, too.
Okay.
And some of the most surprising gaps were in companies you might not expect.
Absolutely. Companies targeting women, for instance, City Chic, which apparently has a 96% female workforce, showed a 67% pay gap.
67% with a 96% female workforce. How does that work?
And Pandora, the jewelry company, a 52% gap. Airlines also had big gaps. Jetstar 43%, Virgin 41%, Qantas 39%.
So what's the explanation given for those big gaps in places with lots of women working,
Yeah.
or like the airlines, diverse workforces?
It often comes down to role segregation within the company. So in airlines, you might have a lot of female cabin crew and a lot of male pilots. Even if the overall numbers are balanced, the pilots typically earn significantly more, and that massively skews the average pay gap for the whole organization.
Okay, so it's about which jobs men and women are doing within the company.
Precisely. And the sources also flag the big banks, Westpac, Combank, NAB, ANZ, all showing gaps around the 18–20% mark, consistent across the board there.
There was also a point made about median versus average gaps. Can you unpack that quickly?
Sure. The median gap across all sectors was mentioned as 13.6%. That's the midpoint half earn above, half below. The average gap was higher at 16%.
Why the difference?
The average gets pulled up by very high salaries at the top end, and those top-paying jobs are still disproportionately held by men. So the average shows a bigger gap than the median.
And it's not just base salary either.
Right. The analysis noted the total salary gap, which includes things like overtime and bonuses, tends to be larger than the gap in just base pay. Again, often because men are more likely to be in roles receiving those extras.
Okay, so this flood of new data, this transparency, what's the significance? What does the material suggest this can actually achieve?
Well, a key phrase mentioned, which really sums it up, is you can't fix what you don't know.
Makes sense. You need the data first.
Exactly. So this mandatory reporting is seen as, firstly, empowering workers. They can use this data in negotiations.
Like the City Chic example, workers there could point to that 67% gap and ask if that aligns with the company's values, especially given its customer base.
Precisely that kind of conversation. And secondly, it holds companies accountable. There's a view discussed that public pressure, potential negative publicity, which companies really dislike, will be a powerful motivator for change. Public shame, essentially.
And for the public sector agencies.
They'll face scrutiny in places like Senate estimates hearings. They'll have to explain their numbers and what they're doing about them.
But is transparency enough? Does the material suggest just releasing the data will fix it?
No, the analysis is pretty clear on that. Reducing these gaps takes deliberate policy and action. It's not just about good intentions.
Any examples given of effective action?
The example cited was the Labour Party implementing quotas, which led to a significant increase in the number of women in politics. The point being, concrete policies often drive change more effectively than just hoping it happens.
And this data release isn't a one-off, right?
That's crucial. It's going to be annual, so everyone can track progress or the lack of it year on year.
Which creates ongoing pressure.
Absolutely. It allows for comparisons. Look, your competitors managed to shrink their gap by X% last year. Why haven't you? It shifts the focus to continuous improvement and demonstrable results.
Okay, so let's try and pull the threads together from this deep dive into the sources you provided. We've covered quite a bit.
We have. On one hand, the RBA's kind of delicate dance with interest rates. We saw how their language might be signaling a shift in priorities, maybe moving beyond just being resolute against inflation to more explicitly balancing that with full employment.
Right, that subtle but potentially significant language change. And then we saw the power of new data with the gender pay gap figures. Really eye-opening transparency, revealing these often quite surprising disparities.
And showing why transparency is such a critical first step, even if it's not the whole solution, it highlights the underlying issues like role segregation.
So for you, listening, understanding these nuances, the thinking behind RBA policy shifts. The concrete reality shown by data, like the WGA report, it helps you see beyond the headlines, right?
Definitely. You get a better grasp of the drivers and the potential consequences of these economic and social trends.
So maybe a final thought for you to chew on. Based on what we've discussed from these sources, how might the RBA's particular definition of full employment, the one tied to not accelerating inflation, shape our society's goals differently than a definition focused simply on everyone who wants a job being able to find one?
That's a deep question. Or, thinking about the pay gap data, How much heavy lifting can transparency and public pressure actually do on their own to drive real change in something as complex as gender pay inequality? How does that compare to the impact of direct policy interventions like the quotas mentioned?
Just a couple of things to ponder. These are just two areas where digging into the details from sources like these can really uncover some unexpected insights and spark those deeper questions.
Absolutely.
Thanks for taking this dive with us today.